Hey there, this is Sam Hartman, Keeping It Real Estate. And today I want to talk about a question I've been hearing a lot about. And that question is, are we heading towards a foreclosure crisis in 2021?
I keep it real, I keep it real, I keep it real, just keep it real.
Like I said, my name's Sam Hartman. I'm a real estate broker in Fort Wayne, Indiana with Coldwell Banker Real Estate Group. And I want to touch base about this question because there are a lot of homeowners right now that are concerned about their home values potentially depreciating, their neighborhoods depreciating, should there become more foreclosures in the market. And a lot of home buyers are wondering, is now even a right time or good time to be buying a home as values are appreciating, but is there a foreclosure crisis on the back end of this that could hurt my investment as well? So I want to talk about this question, bring some of my research, my data, my experience to it, and really put it all in context. I want to look at where have we been in terms of foreclosures, where are we today, and then we can look at where that might take us and where things might lead and how that might affect us in the future, so that families and home buyers and home sellers can make the best decision for their families. So I have a few slides I'm going to touch on. So I'm going to share my screen here. And I want to start with a quote. And that quote is by Jeff Ostrowski, senior mortgage reporter. And it reads, "The COVID-19 pandemic will lead to a rise in mortgage defaults and foreclosures. But as the housing market muscles through this economic downturn, it looks as if foreclosures will form a trickle rather than a flood," housing experts said. So what Jeff is saying here is that, yes, we are in an economic downturn. And so when that happens, people's lives are turned upside down. People lose jobs. Losing jobs means losing income, means not being able to pay their mortgage and things like that, which is a trend that could lead to foreclosures. So certainly anytime you have a recession and people are losing jobs and employment numbers are down, people stand the potential risk of falling into foreclosure. So we do anticipate some foreclosures to tick up because of this. But what I want to begin with and what I want to jump into next is, what does that mean in context? Where are we? Where have we been? Where are we going to? So the next slide here that I want to touch on is going to help us put that into context. And this is historic data. This is historic data on the number of foreclosures per quarter. So you can see here in 2009, quarter two was kind of the peak of that foreclosure housing crisis that began in 2008. You can see that that year, that quarter, took 566,000 foreclosures in a quarter, in a 3-month time frame. And you can see all the quarters right around there from 2008 to 2011 plus, all have had taken some pretty steep numbers in terms of their foreclosure numbers for the quarters. So, but where does that land us historically? And so if we look at the kind of dotted line going through the middle of this bar graph here, you can see that shows the historic average of foreclosures per quarter. And that number is 206,000 foreclosures per quarter. Back in 1909, quarter three, just as a reference point for what's on this graph, took 136,540 foreclosures. That was back in 99. And then looking ahead to today, to 2020, quarter two is what we have the most recent data in, is just under 24,000 foreclosures. Extremely, extremely low. Now, I do want to point out there's a reason quarter two was so low for foreclosures, and that's because the government put a moratorium, a full stop to foreclosures in that time. So that makes sense and reasons to believe we're not going to have much foreclosures when the government takes steps like that. But look at everything leading up to quarter two of 2020. Look at how this graph dips well below the historic average of $206,000 homes of foreclosures per quarter. And you can see that we are well below that historic average. So even if we are expecting an uptick, we still have a lot of wiggle room, a long way to go before we even reach the average that we are historically expecting to be taking as far as foreclosures. There are very few foreclosures in our market right now, even in the quarters past and the years past more recently. So we've got a long way to go. We have a lot of wiggle room, and we are a far cry from 2008, 2009, 2010, where there was a quarter where we had 566,000 foreclosures just in one quarter. So we are a far cry away from that. So this graph helps put into context where things have been the worst and what we're looking at currently. Yes, we might have an uptick in foreclosures, but look how well we've been doing comparatively in the last 6 years of our housing market. We've been well below that historic average of foreclosures per quarter. So that's an extremely positive kind of context PowerPoint slide here to show that and to show where we've been and where we're at now. Next, I want to go into a slide that kind of helps us further define why that is and where we're going and where we might be going forward. So this comes from Aspen Grove Solutions. Unlike in 2008, strategic defaults have not emerged as a serious problem and seems unlikely to emerge. Given stronger expectations for property price increase, a record low inventory of homes, and stable residential underwriting standards leading up to the crisis, which has reduced the number of owners who are underwater. So what does this mean here? We're going to cover each piece of this quote in a little bit more detail. But to start with, strategic defaults. What a strategic default is when a homeowner is underwater on their home, they are in financial constraints, they can't make their payment, and they just walk away. They make a strategic default to just walk away from the home, let it go to foreclosure, not worry about the headache and hassle that could be caused with renegotiating terms with their lender or refinancing or trying to push down that avenue. They just walk away. So there's a few reasons this quote puts into context that this isn't happening right now. And a few of those reasons are, and we'll cover them in more detail here, is the increase in prices, the extremely low inventory, and lending standards have changed since 2008. So we're going to cover all those. So first of all, I want to cover the inventory of homes. Home inventory is something we talk a lot about in the real estate industry, but I don't know if consumers know as much about it. So, inventory, much like, you go to the grocery store and you see what's on the shelf, that's inventory. What homes are available for sale. And we consider a balanced range of inventory to be 6 to 7 months supply of homes. So if not a single home was listed between now and the next 6 months, it would take 6 months for all those listings to sell. That's what we mean by a 6-month supply of inventory. And so anything above 6 months supply of inventory, we consider that to be a buyer's market because there are more homes and more options for buyers than there are buyers seeking them out. So that means buyers have more negotiating power. Homes usually sit on the market for a longer period of time. And this is the case that we found ourselves in from 2008 to 2010, 11, 12, before the markets kind of started rebounding and shifting more towards a seller's market. Now, if we look in more recent years, you see that inventory begins to drop below 6 months supply. And what that means is that it now is shifting into a seller's market. So that means there's less homes, there's less options for buyers to have for purchasing. So those homes usually sell more quickly. They usually have more competition for them. And you can see that as soon as it kind of turned into a seller's market, it has gotten even more and more so. It's kind of stair-stepped its way down. The lowest number on this graph is 2 months supply of homes. Fort Wayne is actually operating at a 1 month supply right around there. So that's how low we are. That's why Fort Wayne continues to be listed as one of the hottest real estate markets in the nation. And that's why it is currently a challenge for buyers to find a great home that they want, because there just isn't a ton of options available. So what this tells me, this inventory and the supply of homes and the limited supply of homes tells me, is that if a homeowner was in financial constraints and was having financial difficulties, they could sell their home fairly easily to get out of that mortgage. They don't have to go to foreclosure. That's not the way to solve their problem. They have options to sell their home without a lot of competition from other homes on the market, with lots of qualified buyers that would come buy it. So that's what that kind of tells me. Next, we're going to go into a graph that's going to talk about home value appreciation. And so we have a lot of companies here, a lot of entities that make home projections, appreciation projections. We've got Zillow on the high end listed at 7%. We've got CoreLogic on the very low end at 0.2%. But most of the projections fall on a very standard conservative average from 5.9% to 3.1%. So most everyone is projecting growth for our nation and for our housing market. Fort Wayne specifically has actually appreciated even more aggressively than the national average. So our numbers look even a little bit higher than these two. So again, what does this tell me? Someone owns a home and they might be in financial trouble, but their home value has been appreciating and is projected to continue to appreciate. So if a homeowner is in financial trouble, rather than letting their bank and their loan be foreclosed on, they have options. They could refinance the equity in their home. They can sell their home and make a profit. They can walk away from that mortgage with money in their pocket, rather than having the home foreclosed on and being out, all the negative things that affect your credit and all the other negative things that are affected by having a foreclosure. So this is kind of the second piece of that puzzle. Homes are appreciating in value. So sellers or homeowners have equity in their homes. That's kind of the key from this slide here. And then the last piece of that puzzle is that the mortgage industry is taking less risk. So there are two kinds of risk that the lending industry takes when they're making mortgage loans. One of them is product risk. What types of mortgages are they offering? The other is borrower risk. What type of borrower are we willing to give a loan to? So you can see this graph and see those big bright orange sections of the graph is before 2008. That was before the housing crisis of 2008. So what was happening in that time frame? Well, banks were giving buyers really risky loans with terms that were going to be very difficult for almost any borrower to repay. So very, very risky. The borrowers that they were lending to were also riskier. Maybe they were lower credit scores, or maybe they had lower income and debt ratios that they were willing to take higher risks on those buyers. But you can see after 2008, after that housing crisis, the government and the lending industry had a lot of constraints put on it that really pulled those things back. So ever since 2008, you can see the lending risk factor has really been mitigated and really been brought under control. Now, this does not mean that, there will never be a foreclosure because they're lowering the risk, but it does mean that the risk is much, much lower that borrowers are going to be foreclosed on, because they are putting more strict guidelines on the type of borrower that they're going to be able to lend to. They're going to have better credit scores. They're going to have better income. They're going to have lower debt before they'll be willing to give them a loan. And they're also giving them lower risk products, things like 30-year fixed rate mortgages, where the interest rate does not change during the whole 30 years of the terms. This, as even though it sounds very normal in our market right now, this was not the norm before 2008. So that is how they have really reduced and mitigated the risk from the lending side of things to try to limit that future growth and that future risk of having another foreclosure crisis. So I'm going to end with one more quote, again from Jeff Ostrowski, senior mortgage reporter with Bankrate. In the first half of 2010, 1.65 million American homes went into foreclosure, according to Adam. In the first half of 2020, barely 165,000 loans were hit with foreclosure actions. Even if defaults rise dramatically, they will remain well below the levels seen during the mortgage meltdown. So I'm going to stop sharing here and just have a little chat heart to heart with you guys here. So yes, the economy took a hit. Fortunately, we've recovered well, but COVID still continues to be an issue. And unemployment is still, at elevated levels. So people are being, continually affected by this. There are people out there whose incomes have been chopped and will be affected by this. So there will be a segment of the housing market that is maybe at a higher risk to defaulting and going to foreclosure. But if we look at this big picture in the grand scheme of things, the whole context of what really happened in 2008 and what's really happening now, it is a night and day difference. We are nowhere close to reaching those levels. We're nowhere close to being in similar constraints from the lending industry and from the housing market. We're actually at a very healthy position as a housing market to continue to plug through this and do well through the COVID crisis. So that is just kind of that context, guys. I hope that is helpful. I hope it helps you and your family in planning your future goals and your future plans, whether to buy a home, whether to sell a home, whether to relocate, and what your plans are in the near future. But I hope that helps put it into context. I hope it helps answer a question that strikes a lot of fear into a lot of people's hearts, but is more, it's more of a headline to strike that fear than it is to actually qualify and explain away that fear too. So I hope that's what I did here today. If you have any questions, any comments, leave me a comment, shoot me a message. I'd love to hear your feedback. I'd love to hear what you are thinking. I'd love to hear what kind of other questions you have that you want me to touch on and try to further explain things based on what's going on in the world right now. So thanks for checking this video out. Thanks for listening. And remember, guys, keep it real estate.
Just keep it real.